morning, ladies and gentlemen. Well, at the risk of stating the absolute obvious, we are in very deep risk off. Minus 56 is a very negative score for spreads, and every single time frame is in deep risk off. Now, that is just stating the obvious. I think anybody who follows the price action will know where we are. So rather than go through the same litany of charts and show you always the same thing, I think it's important that we start looking forward at levels which are important and what markets might or might not do. What we have to conclude is, first of all, whether this is a deflationary or an inflationary shock. It could be both. It could be deflationary in the short term and deeply inflationary in the long term, which I think probably is the case. And I want to go through some charts which will tell us which it is in this phase and how and what levels will indicate that the situation is changing in the long term. Because let's face it, I'm trying to look at what is going to come out of this, whether it's in 6 months' time, a year's time, because this is a time for conviction investing. The short term is so volatile that whatever position you have might be right by 20-30 ticks within 5 minutes or wrong by 20-30 ticks in 5 minutes for no rhyme or reason. And therefore you have to look at long-term levels and long-term spread indicators to tell you in which direction you will ultimately go and what the triggers are along that pathway. First of all, let's clear some misunderstandings about what this chart shows. This chart at the moment shows precisely nothing, because we don't know where the E in PE is. We have various guesses by various people which are way lagging the market. No investment bank is going to come out ahead of time and tell you what their earnings projections are under the current circumstances. They'll come out and give you a sugar-coated view in 1 month's time, 2 weeks' time, whatever. So this chart at the moment is showing you precisely nothing. It's probably showing you that the market is expecting the 17, 18, 19 time or even the 20 plus time to be down here at the moment. Because with bonds yielding what they are, I'll be surprised if the market wouldn't be trading in the 20s in terms of real multiples expected. Okay, so that is what this chart, the only thing that this chart is showing you. It's not showing you that it's trading at 13 times forward earnings. Forward earnings are probably way down here. Okay, it just hasn't caught up yet because people haven't told you what they really believe is happening. That is all this chart is showing you until we get stabilization, and you can see how that period evolved here during 2008, 2009. The market was way ahead of what the analysts finally posted. So only when we find a bottom will we know where we can bounce to, and we are nowhere near yet. So looking at this chart for guidance at the moment is plain, silly. There's nothing that this chart is going to show us, but there are plenty of others that are going to show us what is the market is expecting, because they are leading. And I want to concentrate on those and completely change the format of this video, because I'm trying to look at what is going to happen in a year's time, 2 years' time. It is my contention that the only thing which is going to tell you the truth, what the market expects, i.e. whether we are in a deflationary phase or an inflationary phase, is going to be told to you by only a few things. One is the yield curve. The second is the price of gold. And finally, the spread relationship between various equity markets. Now, the first thing to say is that to me this was the most obvious trade of all time, be long twos tens for a move from the 14 level up to the mid 70s. And it's happened. That's it. It's over. Now, this was a short-term move where the market had to readjust its expectations, and now we get the uncertainty where the market has no idea what is going on. It is it is as clueless as you and me, and basically goes and trades in this range between 75 and back down to possibly as low as 30. If we ever see a move through 13, 14, 15 basis points, we know it's a game changer. It's a game changer because people expect a real deflationary shock, i.e. the Fed can go to zero all it likes. Long-term rates are saying this economy is so screwed that we are going to be below zero for the foreseeable future. This to me is the trigger, this 13 basis points. We start trading below that, we can go a lot negative, a lot negative. On the other hand, if we just stay and trade in this area, eventually we will bust through the 75 area and go a lot more positive, which basically means people are looking for an inflationary shock. Now, if we change this to a monthly chart, we can see that the normal level for 2 years in a healthy economy, 2 years, 10-year spread could be as high as 300 basis points. Okay, this is not unusual, a spread of 300 basis points. You can see how much the risk reward is weighed in your favor to the upside if you are right. This to me is a very important level, 74 basis points. I got out of all my twos, tens, and I'm waiting. It's not going to be quick. It's going to be several months of uncertainty, I think, trading in this area. But when it does start busting through and we get monthly closes or weekly closes in the 80s and 90s, we know that most probably we're going all the way up to 300, which is indicating a very, very heavy dose of what? Of inflation. The other chart that we have to look at, this is a monthly chart of 30-year yields. Okay, so we are going back to the 80s now. What is this chart showing? This chart is showing basically that sometime starting in 1989, 1990, the market started looking forward to globalization. Globalization is deflationary by definition, simply because it suppresses wages, it suppresses costs for companies, and therefore it suppresses inflation. Now, it could very well be that we are now entering a period, a corrective period to globalization. Why? Simply because if governments decide that the price for their support to the market and individual companies and individual sectors like airlines, cruise ships, hotels, you name it, the price could very well be local manufacturing. Employ local people, do things locally, don't import everything from China or Vietnam or wherever the hell. It could be produce locally, employ more local people, have percentages of, i.e. targets of products which have to be manufactured locally to employ the local population. Well, if that happens, it's certainly inflationary in the United States, and certainly inflationary in countries which run both very high budget deficits and also have very high wages relative to the emerging market countries. If that is the case, we will see a spike in inflation and therefore a spike in the yield curve, and that will be felt most in the price of 30-year bonds. Now, this is not necessarily good for the equity markets, but it's very, very bad for the 30-year yield, and it's bad for multiples in the equity markets as well. So we could have a bear market in everything, a bear market in bonds and a bear market in equities. But my suggestion, my contention would be that it would be worse in bonds than in equities, because it just is. Inflation takes off. You need to fund enormous deficits for years and years and years, and therefore the price of 30-year bonds spikes higher. Now, as you can see, we've had a very nice downtrend. This, to me, is exhaustion. We could easily now get a situation whereby we start going through all these levels, and they're marked here and you can look at them. But if we start going back here and breaking these levels, that is inflationary. We'll probably spend several months. I'm not doing this video to tell you what's going to happen next week or the next 2 weeks. I'm telling you what could happen in the next 2, 3, 4, 5 years. And therefore, this is not something that's likely to happen in the short term. This is something that's likely to happen in the long term, and which way you want to conviction position yourself and to have some triggers. Because if the market starts taking out this high here, around the 260 area, you know that something bad is going on. You know that the market is looking forward to something which is going to take us possibly all the way up to these kind of levels, around the 470 to 5% area. Could it happen, and why not? The easiest way to get out of these enormous debts the government will be making is to just simply print money and get the price of the S&Ps up in nominal terms, even if not in real terms. Could easily happen, and this is what the market will be looking at, and these are the levels that I'm looking at. If we now start taking out this 230, 250 area over the course of the next 3 to 6 months, it'll be obvious to me that bonds, long-term bonds with duration, is not the place to be. Gold, of course, will tell its own story. The problem with this chart is that it's expressed in dollar terms. And the dollar is now hugely strong because of liquidity issues. Now, that might take a long time to work through the system, but it still tells us certain very important things. 1457, 1458 is a very, very, very important level. The market bounced off it. I bought it down there, and I'm going to hold it simply because I don't care whether we even go down to 1255 because people sell what they have to sell, what they can sell. Could we get a move down to 1255? Of course we could. But my argument would be that this 1156 is the really important level. If we start going below there, it's deflation in every term. And if we start now closing above the 1658 for a couple of months, then I think the spike is going to be enormous. It's going to be way over. 2000 is going to go without any problems, and then 3, 4, 5,000, and that is the inflationary scenario. If the inflationary scenario comes about, it would not surprise me to see this price treble. Do I know it's going to happen? No, I have no idea. I'm just saying that these are the trigger levels. If you see things go through there, you know that volatility on the upside is going to be absolutely massive, because the market has decided that we are going in one direction. And when the market decides that, it's not going to stop. It's just going to keep going and going and going. So these are the levels. They're all marked here. And, inflation, deflation, those are your triggers. In these extreme times, we have to ask ourselves, well, what would a deglobalized, or where globalization is reduced, world would look like? Well, one of the main beneficiaries in relative terms would be NASDAQ companies, because you cannot stop cooperation of brains with each other. People can work in Kenya, people can work in Tonga, and communicate with their head office or wherever it might be in the United States, and the intellectual property can be booked by companies in the United States which have the knowledge. Now, that would mean that what would benefit the most? Well, the most would be benefited by these companies which are in high tech. And it's not surprising that since 2007, the lows of 2007, we are not even at the 0.382 retracement of the move, which is at 6,400. Okay, so this market has held up very well. We're not even at the lower monthly Bollinger Band, which is around 6,300. Can we go lower? Now, of course we can go lower. We can go a lot lower. But all I'm showing you is that there is some evidence in price for my theory that we are going to a deglobalized world, one in which inflation will be noticeably higher than in the past few years, and that is that people are buying relatively more NDX than they are buying S&Ps. If we now will look at the chart of S&Ps and also of the Russell, and my conclusion is really probably one of the best trades would be to have a butterfly long NDX, short S&Ps, long Russell from these levels, and I will show you why. Now, this is a chart of the Russell. As you can see, it's had been hit the most. It is at the 161.8% of an ABC down. It is at the monthly 200-month moving average, and it's nearly at 0.618 retracement of the whole move from the lows in 2009. Now, why has this market been hit the hardest? Well, it's simply because these companies, a lot of them have never made any profit. A lot of them will go bust, and I think the market has discounted that. But in a world which is deglobalized, companies will appear, smaller companies will appear, which go into this index and manufacture locally. I have been visiting certain companies here in the past few weeks, and they're working flat out. They're working flat out, producing things for the United States government needs, and it no longer wishes to import from China. And I think there's now a move underfoot to produce much more medical equipment and things that the United States finds of strategic interest in the United States, rather than have the components imported from China and elsewhere. So I would have thought that this index at some stage bottoms out and starts going back up relative to the companies which have benefited most from globalization, and that is the S&P. The S&P companies. So to me, it's starting to make sense to buy some Russell companies relative to the big S&P's companies, and to start buying when it falls enough some Nasdaq. So my idea is a very long-term idea: long Russell, long Nasdaq, short S&Ps. Because it makes sense in a deglobalized world. Where are profits going to fall most? They're going to fall most in the big companies which have benefited most from globalization. This is monthly S&Ps, and my contention is that big is not always beautiful, simply because if we do go towards deglobalization, you will find that these companies spend most of their money on basically trying to keep their to pay their wages and to pay higher costs for raw materials and other things that are not they're just caught in the middle. They just have to tread water for years, while smaller companies which are nimbler start producing the components for things that are being produced, and the big or rather the nimble Nasdaq companies produce the advances in technology which humankind will undoubtedly continue to produce. So these guys in the S&P are actually somehow caught in the middle. They're neither benefiting from the local production, in fact that's a higher cost to them, and neither are they terribly innovative, so they are nowhere. To me, this kind of trade makes sense. Avoid the S&P companies, start nibbling slowly on the sectors that have been hit most, i.e. Russell, and start buying dips in Nasdaq against shorts in the S&Ps. Finally, I wanted to have a look at volatility, because it's telling a story. Now, I told you that if you go through 40, it's going to 80. Okay, that's happened, that's done. But the most important thing that I saw last week was how volatility kept on getting hit from that 80 level, and it collapsed down to 65. That's a big move, that's 20+%, while the market just could not rally at all. The S&Ps didn't rally, and finally got absolutely smashed towards their absolute lows, and volatility did not rally. Now, look, we can argue until the cows come home, but this is a very significant event that's going on in the world, and the other significant event was 2008, 2009, and this is what we saw. We saw basically a move up to the 80s, then, several moves back down towards the 40 level and back up towards the 80 level. All the while here, the market was making new lows and volatility was not. Okay, so this is normal behavior, I would argue, now for volatility. You will see the S&Ps go lower and lower, and volatility just go back up and not go through the old highs. And it'll be in a range between the sort of low 40s and 80, and finally at some stage when the market has bottomed, it'll break 40 and stay below 40, stay below 40, stay below 40, and go down towards the 20s. That is the kind of behavior that I expect for the next several weeks, while the S&Ps yo-yo up and down, but with a downward bias. Volatility never breaks the 80s again. And that will finally, after many weeks, set up the divergence which is needed to say that the market has bottomed and we now can start going up. So do not think that you can hide in volatility from now on. It's unlikely that volatility makes new highs. That is unlikely. At 80, it's a huge sell, and in the mid 40s or high 40s or whatever, it's a buy, because you will have this yo-yoing going on between 40 and 80 for many weeks. It could be that we are going to repeat exactly this kind of picture right here while the market goes down. Have a look, this is, I'll give you the dates so you can have a look and compare them to the S&Ps. Okay, so this first bar here is October of 2008. We didn't bottom until March of 2009, and that is here somewhere. Okay, so you get the picture. Between October and March, that is, 6 months, right? We just went between 43 and 80, 43 and 80, and this is now March. This is December, and now we get the market starts anticipating, and this is March, and this is the new lows, and look how much lower volatility is, and then it gets smashed. The market bottomed here. This is where the market bottomed in 2009, and look how much lower volatility was then in October, and the S&P still kept on making new lows. Therefore, do not be surprised to see that kind of divergence happen this time as well. I wanted to leave you with one final chart, and that's the dollar index, and a lot of people will actually be shocked by how low the dollar index really is relative to the extremes that we've had in the past decades. This is where I started trading, and it was one way up. Basically, we went from 102, 105, we went to 160. This is the Plaza Accord. The market had well turned before the Plaza Accord, and really I would argue that the dollar is now potentially a wrecking ball to everything, especially to S&P 500 companies. If the dollar now starts going parabolic up, the profits of the S&P 500 companies are dead. That's it. We are potentially in that kind of scenario, and I would argue that this period of low dollar, basically trading around par, or lower, is what enabled globalization to take place in the first place. Companies in other countries could borrow and create their industries and supply the US market cheaply. If that is no longer in the United States' national interest, they might just not care about that anymore and just let the market rip. If they do that, the dollar is just going to go parabolic. We've had such a long period of low volatility here. We've had like 5 years of the dollar trading in a arguably 5-6% range, that now we could get an expansion that is just silly. Certainly this kind of level should not surprise the 120 level. That is so destructive for S&P 500 profits that it's just, what to say. It would be enormously deflationary, and that is the thing. You could have a period of deflation masking a period of what will then become rapid inflation. That is why it's so difficult to predict what is going to happen short term, and that is why I think the odds of a rapid bottoming in the S&Ps are far less than an odds of bottoming in Russell or in the Nasdaq. When you think about it, the Nasdaq companies don't really care about the level of the dollar. If you got to buy technology, you got to buy technology. It doesn't really matter what currency it's denominated in. And if you produce locally, you don't care what the dollar is. So that is what I'm saying. I'm seeing more and more signs that actually to be in the S&P 500 is the wrong place to be, and really that the trade could be long local companies and long massive and long very companies which sell intellectual things, and short companies which are big and therefore less nimble, less able to innovate, and more exposed to the vagaries of the dollar. This dollar could really go. It starts breaking the weeklies 103.30, and you can see how important that has been on the weeklies. It can just go to 120 in 2-3 weeks. Do not be short of volatility in dollars. It could just be massive. And that's all I've got to say. I had to change the format because I'm trying to do the least possible harm. I'm trying to show you how I think. Some of you might not like it, but I think trying to predict the next 20 ticks in this market is pointless. You have to start looking at the much bigger picture and the trends that will emerge from that much bigger picture. Thank you very much indeed, and tweet you on Monday.